This was supposed to be a $1.5 billion stadium. It is now approaching $2 billion, and the gap is still not fully explained. Why is this happening? What is being hidden inside the financing structure? And who is really benefiting while Nevada taxpayers remain exposed to hundreds of millions in obligations? At the same time, a second problem is quietly emerging. Private investors are not stepping in. The capital that should validate this project is missing. And yet, construction continues. This is no longer a projection of risk. It is a system already under pressure. Stay with us as we break down where the money went and what it reveals. If you value clarity over headlines, consider liking, subscribing, and turning on notifications. The origins of this project trace back to June 2023, when the Nevada legislature approved Senate Bill 1 and Governor Joe Lombardo signed it into law. At that moment, the Oakland Athletics' relocation to Las Vegas was framed as a controlled, structured investment. The official cost stood at $1.5 billion. The timeline targeted a 2028 opening. The vision was clear. A modern Major League Baseball stadium positioned on the former Tropicana Las Vegas site at the intersection of Las Vegas Boulevard and Tropicana Avenue, one of the most visible locations on the Strip. The positioning was strategic. Las Vegas had already absorbed the Raiders with Allegiant Stadium in 2020, and the narrative was that baseball would complete the city's transition into a full-scale professional sports market. The A's ownership, led by John Fisher, presented the project as the next logical step in that evolution. A smaller-capacity, climate-controlled ballpark designed specifically for the Las Vegas environment, integrated into the broader tourism ecosystem. At that time, the assumptions were stable. Tourism demand was rebounding post-pandemic. Visitor volume, according to LVCVA data, had recovered above 38 million annually. The Strip was generating record gaming revenue. The environment appeared supportive. But the contrast begins to emerge when you compare that initial positioning with the present structure. What was introduced as a contained $1.5 billion development has now expanded toward $2 billion. What was framed as a fully structured financing plan now shows visible gaps. And what was marketed as a high-confidence investment is now facing hesitation from the very capital sources it was designed to attract. This is where the narrative begins to diverge from the original premise. At the center of this project is a layered structure that separates control, risk, and ownership. The land itself, formerly occupied by Tropicana Las Vegas, is controlled through agreements tied to Gaming and Leisure Properties, Inc., a real estate investment trust that specializes in casino assets. This is not a traditional ownership model. It reflects a broader trend across Las Vegas, where the underlying real estate is decoupled from operations. The Oakland Athletics organization, under John Fisher, is positioned as the operating entity. They are responsible for the team, the stadium operations, and the revenue generation. But they do not fully control the land in the traditional sense. This introduces a fundamental dynamic: a lease-based structure. While full details remain partially opaque, the framework aligns closely with a sale-leaseback and triple net lease model. Under this structure, the operator is responsible for rent, maintenance, insurance, and property-level costs. These are fixed obligations. They do not adjust based on performance. In addition, lease agreements of this type often include escalators, annual increases in rent that compound over time. Even if revenue growth slows, the obligations continue to rise. On top of this sits the financing stack. Public contributions through SB1 include approximately $180 million in transferable tax credits and around $120 million in county-backed bonds. Private capital, was expected to fill a significant portion of the remaining gap, with an initial target of $500 million in external investment. But as of mid-2025, that capital stack remains incomplete. This creates the core pressure mechanism. Fixed obligations tied to a structure that is still searching for capital. And that is where the risk begins to concentrate. To understand the current position, we need to look at the operating side of the franchise itself. As of March 2025, Forbes estimated the Oakland Athletics valuation at approximately $1.8 billion, representing a nearly 50% increase year over year. This surge was not driven by on-field performance. It was driven almost entirely by the Las Vegas relocation narrative and the projected upside of a new stadium on the Strip. But valuation is not cash flow. On the revenue side, the A's remain one of the lowest performing franchises in Major League Baseball. Recent seasons have placed their annual revenue in the lower tier of the league, with limited ticket sales, reduced attendance, and one of the smallest payrolls in professional baseball. Attendance trends reflect this gap. During the 2023 and 2024 seasons, average home attendance remained among the lowest in MLB, often below 10,000 fans per game. This is not a temporary fluctuation. It is a sustained pattern. From an EBITDA perspective, publicly available estimates suggest thin operating margins, with profitability heavily dependent on revenue sharing and league-wide distributions rather than strong local performance. This creates a structural contrast. On paper, the franchise is worth $1.8 billion. In practice, its operating fundamentals remain weak. And that divergence becomes critical when the valuation is used as the foundation for raising new capital. Because investors do not just buy narratives, they analyze cash flow. This is where the structure begins to show visible stress. The first layer is fixed obligations. Under a lease-oriented model, the operator carries ongoing rent payments that do not adjust with performance. If the agreement includes escalators, those payments increase annually. Revenue must grow just to maintain equilibrium. The second layer is debt servicing. Public bonds tied to the project, particularly the $120 million issued through the Sports and Entertainment Improvement District, introduce long-term repayment schedules. Even if structured through tax capture mechanisms, the underlying assumption remains the same. Revenue must be sustained at projected levels. Then comes capital expenditure. A $2 billion stadium is not a static asset. Maintenance, upgrades, and operational costs continue post-construction. Depreciation adds further accounting pressure, especially in early years when capital recovery is limited. Now combine these elements with operating leverage. A baseball franchise with historically low attendance is now tied to a high-cost, fixed expense environment. That creates asymmetry. When revenue grows, margins expand slowly, but when revenue underperforms, the impact is immediate. And the signs are already present. Cost escalation has exceeded initial projections by roughly 33%. The private funding gap remains unresolved. Investor participation is limited. At the same time, fixed obligations are already being structured into place. This is not a future risk. The pressure has already begun. To fully understand the risk, the project has to be placed within the wider Las Vegas market. According to data from the Las Vegas Convention and Visitors Authority, total visitor volume reached approximately 40.8 million in 2024, recovering beyond pre-pandemic levels. Harry Reid International Airport reported over 57 million passengers in the same year, signaling strong inbound traffic. But growth at the macro level does not distribute evenly. The Las Vegas Strip continues to dominate high-end tourism, driven by premium pricing, luxury resorts, and international visitors. At the same time, the local market remains under pressure. Disposable income among residents has not kept pace with rising costs. Spending is becoming more selective. There is also structural competition. Online gambling continues to expand across multiple U.S. states, diverting a portion of gaming demand away from physical destinations. This does not eliminate Las Vegas demand, but it changes behavior. Trips become less frequent, spending becomes more targeted, and then there is pricing. Over the past 3 years, average daily room rates on the Strip have increased significantly. Resort fees have expanded. Food and beverage costs have risen. The traditional value perception of Las Vegas is shifting. This creates a more complex environment. Because while headline numbers suggest growth, underlying behavior is becoming more constrained, and that matters for a project that depends on sustained, high-volume demand. On the surface, everything appears aligned. The franchise valuation has climbed to $1.8 billion. Visitor volume in Las Vegas is above 40 million annually. The Strip continues to generate record-level revenue, and the project itself is moving forward with construction activity already visible. But beneath that surface, a different picture emerges. Costs have expanded from $1.5 billion to nearly $2 billion. Private capital remains incomplete after more than 20 months of fundraising. Operating performance at the team level remains among the weakest in Major League Baseball, and the financial structure relies on fixed obligations that will increase over time. This is the paradox. Externally, the narrative is growth. Internally, the structure is tightening, and that divergence is where long-term risk begins to form. Because when valuation, pricing, and expectations continue to rise while the underlying fundamentals struggle to keep pace, the system does not fail immediately. It destabilizes gradually, and that process is already underway. So the question is no longer whether this stadium will be built. The real question is whether the structure behind it can hold over time. Because what we are looking at is not just a construction project. It is a financial system built on rising costs, incomplete capital, fixed obligations, and assumptions about demand that have not yet been tested at scale. If visitor volume slows, even slightly, how does the model respond? If pricing continues to rise but value perception declines, what happens to attendance? If private capital does not fully materialize, how long can internal funding sustain the gap? These are not theoretical concerns. They are structural variables that will define the outcome of this project over the next decade. And history offers a consistent pattern. When asset pricing moves ahead of fundamentals, the system eventually recalibrates, not through headlines, but through performance. So this becomes a long-term test, not just of one stadium, but of the modern Las Vegas model itself. If this structure proves sustainable, it will reinforce the current trajectory of high-cost, capital-intensive development supported by public participation. But if it begins to strain, if the numbers fail to align with reality, then this project may represent something else. A signal that the balance between growth, risk, and sustainability is beginning to shift. If you want to follow how this story evolves beyond the surface narrative, consider liking, subscribing, and turning on notifications.